I want to start off first by again thanking all of you for joining us this evening. We really do appreciate you taking the time out of your day to be here with us. We hope that you find today's presentation to be helpful and informative for you on your journey to building a home. Before we begin the presentation, I do have a few housekeeping details that I'd like to go over. Tonight's event will be recorded to make this information available for you to look at afterwards and anytime if you need to reference it. Tomorrow, you will be receiving an email that will have the recording for the event, along with your coupon for $100 for closing costs and other helpful information to help you in your home building process. Please be on the lookout for that email that will again be coming from us tomorrow. If you have any questions throughout the presentation, please feel free to drop them in the chat box and send them to First Federal Lakewood. We will be having a Q&A session towards the end of the event, but we will try our best to answer questions as they come in and throughout the presentation. I'd like to also thank those of you who have already submitted your questions. We did receive a handful of really great questions that we made sure are either answered throughout the presentation or we'll be sure that we ask those during the presentation as we move along. I would like to now introduce you to our three presenters for the evening. First off, I would like you to meet Chris Bardish. He is one of our mortgage loan originators here at First Federal Lakewood. He has more than 15 years of experience in the mortgage lending industry. Next up, we have Dave Meadows, who is another one of our mortgage loan originators here at First Federal Lakewood. And Dave has been with us for almost 10 years. And last but not least, we have Beth Ann Silverman, who is another one of our mortgage loan originators and has been with First Federal Lakewood for over 10 years. All three of our presenters tonight are really great resources, and I'm looking forward to hearing them during our presentation tonight. One last note before I hand things over to our presenters. While Chris, Dave, and Beth are all here to speak to you tonight and are great resources for you to use on your home building journey, we also want to encourage you to look around and compare rates, compare products, and even look at different personalities. We want to make sure that you are finding people that you are comfortable working with. I know that all three of our loan officers here today would be happy to assist you and would love to work with you. But again, we want to make sure that you find someone that you work with that fits your needs best. As one last final reminder, if you have questions at any time during the presentation, go ahead and drop them in the chat and send them to First Federal Lakewood. With that being said, I will now hand things over to Chris to get us started.
Hi, my name is Chris Bardish. Thank you for joining us at our Building a Home event. We're excited to discuss the construction of permanent loan and building a new home. Tonight, we're going to provide a blueprint of the construction loan to give you a great option if you're considering that next home. Now you're probably thinking, how can you build with rising lumber prices right now? Well, if you've been looking for a home to purchase, I'm sure you'll agree that it's been quite a challenge looking for a home right now with a limited number on the market and finding that one house with those must-haves. With a construction loan, it gives you the opportunity to get that first floor master, 3 bedrooms, or even the open concept you were looking for, creating that customized space based on your needs. Now, there are a couple of different types of construction loans out there. Today, we're going to be focusing on probably the most common, a conventional one-time close construction to permanent loan. What is a construction to permanent loan? Well, it enables you to finance the cost of building a new home, allowing you to combine the construction financing and the permanent mortgage into one loan. So it's a single loan to buy the land and fund the cost of the build. And then once the home is complete, it converts to a regular mortgage. Just like any other mortgage, there's different loan options. With a construction loan, you have different options like a 30-year, 20-year, 15-year fixed, along with adjustable rates depending on your loan situation. A construction loan can be used to purchase a primary residence or even a second home, like a vacation home for you. Many advantages of the construction loan. Like I said, you have one loan, which equals one application and one closing, which avoids the worry of possibility of having a second set of closing costs. And depending on your loan type, you can borrow up to 95% of your home's property value with mortgage insurance. With a construction loan, you can save on mortgage costs by only making interest-only payments during constructions. So the interest-only payments are based on what is drawn of your loan funds. So during the construction period, your payments are minimal and they gradually get larger as construction is being completed. And that can certainly help if you have a current house payment or even a rent payment during the build period. Now, a great advantage of the construction loan is that you get to lock a rate early before a shovel's put into the ground before the start of construction. That can give you some peace of mind, especially in a rising rate environment when you have a build period of 6, 8, 12 months. And again, with existing home inventory being low right now, it is a perfect opportunity to build your dream home. Now, Beth Silverman will be talking about some nuts and bolts to building your home, what you need for pre-approval, required documentation, and walking you through the application process through closing. Thank you.
Hi there. So my name is Beth Silverman. I love working on construction loans. It's actually my favorite kind of loan because I feel like I'm part of something very big, taking your plans, your dreams, your ideas, and turning it into, you know, your vision into reality. So it's really fun to work on these loans. My recommendation, if you're considering a new home, is to go to a loan officer that specializes in construction loans. They could be your best friend because they're going to be able to answer all of your questions. I usually get questions, you know, hey, is my builder on your bank's approved builder list? Because our builders do need to be approved with us. How do these loans work exactly? Is it just like buying any other house? How is it different? How big of a project might I get approved for based on my income? How much do I need to put down? What are the closing costs? Hey, I already own a home. Do I have to sell it first, or can I build this new home and sell my house later? And if I sell my house later, can I put more down on the construction loan? And then also, what could I expect for a monthly payment based on current rates and the project size? And we can help you calculate estimated future taxes. So at least before you sign your name on a contract, you'll have a lot of information and you'll go in as hopefully a much more informed buyer. So I think it's a very valuable process. The loan approval is not a commitment to lend. It's really just a tool to help you understand what sort of home you qualify for and what you need to be prepared for. So we help you build a bit of a roadmap. So you go through all that and you think to yourself, okay, I'm in. I'm going to go ahead and I'm going to build a house. So what is next? Just like any other house, when you apply for a construction loan, you need to turn in everything like you would for any other home loan. We're going to be looking for pay stubs, bank statements, that sort of thing. But on top of that, and when the process can get started, is when you've signed a contract with your builder, when you've acquired the land. Sometimes the land acquisition is actually part of the builder contract. Sometimes it's a separate contract. Either way is fine. And sometimes you actually already own the land, which is kind of nice. So we work with all three of those situations. But once we have the signed builder contract, a set of the blueprints, the lots identified, we can now start the official loan approval. That's when you can lock in your interest rate. And the interest rate that you lock is going to carry you all during construction. And then that's going to be your rate once it converts to principal and interest after the construction is completed. And rates are just fabulous right now. So building a house in terms of finance costs are very, very reasonable. So you're under application. We send out some initial paperwork that has all of the terms and conditions that are involved with the construction loan. We also give you a detailed breakdown of all of the closing costs. We make sure we go over that with you so that you understand all of the costs. And if that looks good, we ask you to sign the documents. We have gone paperless, but we can work with paper if push comes to shove. But typically, our borrowers will go ahead and e-sign the paperwork. And it's at that point that we can order your appraisal. And I always get this, like, what the heck are you going to appraise? You know, it's a chunk of land, you know, it's in the middle of nowhere. But what the appraiser is going to do is he's going to scope out the neighborhood, because we all hear with real estate, location, location, location. Where is this house going to be built? What's its square footage? How many bedrooms? How many baths? And the appraiser's job is to come back to us and say, hey, once this house is built per these plans and specs, it is my informed belief that the home is going to be worth X number of dollars. The hope is that this value that the appraiser comes up with kind of closely aligns with what you're paying for the house. If it doesn't, and the appraisal comes in less, you know, maybe it's time to go back to the builder, see if there's some things you can cut, or maybe you're willing to put a little extra down. But we would address all that stuff once the appraisal came in. We also will send the file through for a full credit review. So an underwriter takes a look at your income, your credit history, your assets, and they will issue a loan commitment. Sometimes there's conditions, but they will approve the loan. And once that is all together, it's actually time to go to the closing table. And what that means is documents, final legal documents are drawn up. You'll meet with a settlement agent, a notary to sign that paperwork. And that's actually when you need to come up with your down payment and your closing costs. So you need your money, your down payment money, and closing costs before construction begins. And if you're buying a lot at the same time, after you sign that closing paperwork, the lot transfers into your name so that the builder is building a house on land that you own. You will also need to purchase something called a builder's risk insurance policy. And that's basically covering any damages to the property that happen to occur while the home is under construction. So we'll talk to you more about that later if you get to that point, but you do need a special kind of insurance. And then after that, it's all systems go for the builder. They are not allowed to start construction, though, until you've actually closed on your financing, sign that final paperwork. And that's when construction begins. And that's also where my friend Dave can jump in and talk about how to take you from loan closing to a built house and what that process is.
Awesome. Thank you, Beth. Can everybody hear me okay? Yep, we're good. All right, fantastic. Well, hey, again, my name is Dave Meadows. I'm a mortgage loan originator out of the Avon Lake branch. And as Kayla said at the beginning, I've got 9 years here at First Federal Lakewood, but 29 years total in mortgage lending. So I've done quite a bit of construction loan over the years, and want to just give you a quick overview of the construction period. So obviously you've gone through the application process, you've got your loan approved, your loan is now closed, and you've got a chunk of money. What happens to it? Where does it go? It actually gets placed in a construction escrow account at the lender, and then the funds are dispersed to your builder based on a percentage of the completion of the home as it's built. Typically that's done using a 5-draw process where they take draws in 5 steps as the house is completed. That can be tweaked if need be. It can be done in less or more if needed. Basically, once the draw request is requested by the builder, you know, they can take an extra draw at the beginning if they need to cover such items as blueprints, permits, or upfront materials. And typically, that should not exceed 10% of the total construction funds. So I'm going to go ahead and also give you a little bit of information on the draw request procedure. Now, this process that I'm going to give you is the draw request option that happens here at First Federal Lakewood. So this may vary from lender to lender. It does give you an idea of how it works in most cases, and especially here at First Federal. So typically what happens is the builder will submit a draw request to First Federal upon whatever phase of construction they have completed. At that point, the lender would order a property inspection and a mechanics lien update from the title company. So basically what they're going to do is send an inspector out to the property to make sure that that portion of the work has been completed. And then the title company is going to do a title update to make sure that there were no mechanics liens filed against your title through that draw period. As long as both of those, the inspection and the mechanics lien update comes back clean, the lender would then disperse funds to the builder based on that completion of work. And then obviously we need to make sure that the completed draw request, any affidavits that need to be signed, as well as the mechanic lien update and the inspection report has been received by the lender. Again, as Beth mentioned in her section, funds are only dispersed for work that has been completed and inspected. The next section we've got is what happens at the completion of your construction. So you've got, the house complete. You're ready to finalize everything and get it converted from construction to permanent financing. Again, the completion portion of your loan, so the interest-only portion of your loan, is determined at the front end with discussions between you and the builder. Typically, that runs anywhere from 6 to 12 months, with our normal build period being an 8-month interest-only period. As long as you fall in that time frame, we would get ready to convert that upon the final draw to permanent financing. And at that point, either you or your builder would provide the bank with a copy of the final certificate of occupancy. Now, that's not always applicable in all locations. Sometimes in townships, they don't issue occupancy permits or occupancy certificates. So if you don't have one where you're building, that's totally fine. And then they also order a final as-built survey if required by the title company. So basically what they're doing is surveying the build to make sure that it was built where it was supposed to go. Then the final inspection recertification of value is ordered through the appraiser, and then the final title update is ordered as well. You and your builder would then sign a construction completion certificate stating that everybody's aware that the house is 100% complete and that we can finalize the last draw and pay the builder the remaining money in your construction escrow account. And then once that's completed, the loan would then convert from a construction loan to your permanent financing. Again, that is done automatically at the completion. So it's a one-time close. You don't have to apply for another loan. It just automatically converts from construction to permanent financing at the end. Now, let's say, for example, you do set up an 8-month interest-only construction period, and for some reason the builder runs long. That does happen. Let's say there's a delay in getting materials, or maybe there's weather-related delays, snow, rain, whatever, that may cause the builder to run longer than the amount that we've set aside at the beginning of the build. We have options of either converting that. If we're close and we're going to convert that loan to permanent financing anyway, we can go ahead and do that and then finish up after the conversion. Or we can look at potentially modifying the loan to include additional months on the construction period. So we would, if we needed 2 more months, we would change it from 8 months interest only to 10, and then convert at the end of the 10th month. So that option is there as well. So that's kind of the basic nuts and bolts of post closing on the loan, during construction, and then conversion to permanent financing. So at this point, I think I'm going to kick it back to Kayla and see if there's any questions that have come through.
Thank you guys so much. That was so informative and so helpful. I know a lot of the questions that we had come in advance. You guys did a great job of answering those questions. If anybody else has any questions, again, you can send those to First Federal Lakewood, and we will go ahead and ask those questions now. I know one question that had been submitted quite frequently was, how do you coordinate the sale of your existing home while you are working on building a new home? Beth, go ahead.
Okay. So that's a big question. There's a couple ways to go about it. If you're in early days, early planning days, and you're not under contract, one option is to take out a home equity line of credit on your home. And then this way, when you finally select the right builder, get your plans drawn up, you'll have that in place, and then you can use that as a down payment on your home. So usually there's no closing costs involved. So it's a pretty useful tool for building a house. The problem is that once you're under contract, that option is gone because you actually are under contract for a new house. And so you would not be able to take out a line of credit. So in that case, another option is you can put down a minimum down payment. So I'm working with a gentleman now. He owns his home in Texas free and clear. He's building a house to be by his kids in Cleveland. He doesn't want to sell his house until the new house is built because he doesn't want to live in interim housing. So his plan is, after he's putting minimum 5% down, and after his home closes, he's going to make a very large principal payment on that loan. And it's going to be so big that there will be no PMI. That'll just come right off. And he's going to ask us to recast his mortgage note, which means we recalculate the monthly payment based on now your lower principal payment. And this is not having to refinance with all the refinance costs. There is a modest fee for us to drop this new document, but this is a very popular way of handling moving equity from a current home into a home that you're building. The last way, which we tend to shy away from it a little bit, but there is something called a bridge loan. And that's just a separate loan on your current home, and you can pull out equity towards your down payment. But we shy away from that a little bit because that does come with a couple $1,000s worth of closing costs. And sometimes it's just less expensive altogether to put down a minimum down payment or pre-plan that home equity line of credit. Does that make sense?
I think that makes sense. Does Dave or Chris, do you have any other comments to that?
Yeah, I think I'd like to piggyback a little bit on Beth's home equity line of credit idea. It's great if you're definitely in the pre-planning stages and you are you're not 100% ready to go with the builder yet. I've tended to tell people to for qualifying purposes, especially if we're in the pre-approval stage for the construction loan, and maybe you haven't knocked out the builder choice yet and you don't have the final numbers, but potentially if you've got a house to sell and maybe we're not getting the debt to rate income ratio numbers to work out, the home equity line of credit can be a very good tool, not only to pull down payment funds, but in some cases, you can, if you have a first mortgage on your house, you can use that home equity line to pay that first mortgage balance off in addition to the down payment funds. What that does is that allows you to convert your principal and interest payments to an interest-only payment. And it may help you qualify for the construction loan because we're doing just an interest-only payment for qualifying purposes.
Good point.
Great, thank you for that. We do have one more question that has come in. From application to closing, about how long does it usually take to close a construction loan?
So I would be happy to answer that. You should plan for between 30 to 45 days. And during the busy season, it might be a little closer to the 45 days.
Okay. And one more question we have that has come through. Does my builder have to be approved by FFL or by your bank?
I would be happy to answer that as well. Yes, so we want to approve builders. We're not approving their workmanship per se. That's on you to get references, make sure you like their quality work. But we do have to trust them with large draws of money to pay their subcontractors and material vendors in a timely fashion. So there is a builder approval process. It does not take long. It's not hard to get approved. But if you're working with a builder that's not already in our builder list, we have a little builder packet that we send out. They send back, and I usually hear within a day or two if they're approved.
Thank you guys for that, all that help on our questions. I don't see any more questions have come through yet. So with that being said, I think we have come to the end of our presentation. Does anyone else have anything to add before we wrap up? Any final thoughts?